The Federal Reserve cutting rates at its final meeting of the year, but inflation could be headed higher before falling back to the 2% target. Joining me now, J.P. Morgan Asset Management Chief Global Strategist David Kelly. David, great to see you again.
Glad to be here.
So listen, the Fed rate cut this week, not a big surprise, but spin it forward for us. What does this mean as we head into a new year?
Well, I think actually their actions were a little bit more dovish than people realize, because not only did they cut the federal funds rate by 25 basis points, but actually the way the federal funds rate was trading in the markets, it was trading about 0.06% too high. And they sort of fixed that by buying a lot of treasury bills and implementing a new program to do that. So really, we got 31 basis points of a cut for the price of 25. So a little bigger cut than perhaps people had expected. But they also said, going through next year, the majority of the members of the committee still expect just one rate cut next year. So I'd say it's dovish in the short run, kind of hawkish longer term.
And you're also calling attention to another bout of stimulus we can expect in the spring in the form of tax refunds.
Yes, I don't think enough people paid attention to this, but when they passed this big tax bill in the middle of the summer, they made a lot of the new tax cuts, in fact, all of the new tax cuts, retroactive to January 1st, 2025. But they didn't change the income tax withholding schedules. And that means that when people start doing their taxes early in the new year, they're going to find that they're owed a big refund. We think the average refund is going to go from $3,200 this year up to $4,000 next year. So that's like an $800 stimulus check. And most of that will be paid out before the end of March. So we think the economy is going to get this little surge of consumer stimulus here that's going to push up consumer spending. And, along with the AI boom and a good stock market for this year, I think all of that will keep consumer spending and the economy pretty hot in the first half of next year.
Does hot mean inflation? And what does that mean for the first half of the year? And will that cool down by the end?
Yes, I think it does. And I think it's not just that this growth would cause inflation. It's that I think the retailers are trying to find a way to pass on these tariff increases to consumers. The Walmarts and the Home Depots of the world, they've already paid the tariffs, and they're paying the tariffs as they import this stuff. They've been reluctant to fully pass them on to consumers. But if consumers have got pockets which are full of tax refunds, that's a perfect opportunity to push up these prices. And because of that, we really don't think that inflation will peak out until perhaps June of next year, somewhere between 3.5% and 4%. And after that, if there's no further stimulus, if we don't get some tariff rebates or something, I do think inflation will come back down to 2% at the end of the year. But I think we've got higher inflation before we see it cool down.
Well, 2% at the end of the year would be great for the Fed, right? That is their target. Would that be good news, I think?
Well, yes, it would be, but I do think that we need to get there first. And okay. I think they are very suspicious that Washington will find some other way of stimulating the economy and stimulating inflation before the end of next year. But overall, we do think that without more stimulus, the economy is going to have an okay year next year, but the first half is going to be stronger than the second. And as we go into 2027, it's going to be a pretty sluggish economy. We're not thinking recession, but pretty sluggish.
All right, it is an election year, so we know that the government pulls out all the stops in those cases. As an economist, give me the big picture view here. You've noted that there are a lot of cross currents. So the stock market, of course, has had a wonderful 3 years, but consumer sentiment is in the dumps. The economy, you say, it's chugging along okay, not spectacularly. Why the disconnect?
Well, it really is a K-shaped expansion where the top 20% or 10% are doing very well. And the rest of the population is really still getting squeezed by the inflation of the last few years. And the thing about consumer confidence surveys is everybody gets one vote. It's the most egalitarian of all economic measures. Now, in the real economy, what richer households do is much more important than what poorer households do. I mean, the state of inequality in income in America today is that the top 10% have got 50% of the income. I mean, that means if 10 people walk into a 7-Eleven tonight, the 10th person in the door has got the same income as the first 9 combined. Wow. And so what that 10th person or the 9th and the 10th person do, that's really important for the economy. So the economy can move forward while confidence is up. And meanwhile, the stock market's being helped by the fact that people have got huge capital gains and they really don't want to sell because you're going to have to write a check to Uncle Sam right away. So the things that are stopping money from coming out of the market. So if anything, I think confidence is understating economic strength, but I think the stock market is overstating economic strength right now.
Thank you. Just one more question. I do have to go, but what's your quick investment advice heading into 2026?
Rebalance, because I think rebalance in a tax smart way, but really pay attention to it, because I think a lot of people are a lot richer than they were a few years ago, but they're very concentrated in these mega cap tech stocks in the US equity market. And sooner or later something will go wrong. Not the time, the day, nor the hour, but you do know where it's going to happen, and it's going to happen in those big tech stocks and in other areas of a lot of speculation. So you want to get a more balanced portfolio. That's really the New Year's resolution: get balanced for 2026.
I will take that. I'll put that on my list. Thank you.